Should you invest in apartments? You may have heard the old property investor adage, always buy land, don't buy an apartment. A lot of mums and dads have been saying this for a long time. But here at Confidence, we've unpacked the data and it shows a potential appreciation in unit prices outperforming house prices over the next few years. In this episode, we're going to go through the what should I invest in, and more specifically, apartments. We're going to go through a few different reasons why they will do well in the short run, and also touch on the long run and whether they'll make good long-term investments too. Curtis, I know you're excited by this one because you, my friend, are an apartment owner. Is that correct?
Yes. Yeah, I have one in Canberra. And then my fiance, she's got one in Sydney as well. So I'm a little overexposed to the apartment game. So that sounded like a very positive intro for me. I'm very excited to hear where this podcast is going.
Yeah, that's true. That's true. So, apartments are making up more and more as a share of the total dwelling stock in Australia as, we're building more apartments. There weren't many 50 years ago, but now they're everywhere. And more people are investing in them. More and more people are using them to live in and even have a preference to live in apartments versus houses. But we've commonly heard from other property investors as don't buy an apartment. They don't do well. There's strata issues, there's building issues, yada, yada, yada. Here, we're going to try and debunk some of that and explain why, using a little bit of a framework to show why apartments are going to do well between 2024 to 2027, the medium-term window, the next few years. And this is starting to show up in Sydney data. Specifically in the month of April, apartment prices rose at double the rate of house prices. Maybe that's an anomaly here, but you're seeing apartments catch up in terms of price growth finally here in Sydney. It's just a small 1 month piece of data, but is this a trend that's going to continue?
Yeah, and I think, when we're talking about the long-term fundamentals, always kind of default back to the land value being, one of the most critical factors. So, if you're holding something over a 20-year window, 30-year window, something like that, the opportunity for that kind of capital growth or the development potential or uplift on utilization is all attached to the land, which doesn't come with an apartment. So I think for the long-term fundamentals, that kind of debate and that question is still there. But like you're saying, the conditions in Sydney and probably a lot of Australia at the moment mean that over the next maybe 5 years, there's a few key factors that might put a lot of upward pressure on apartment prices specifically, as opposed to upward pressure, the just general upward pressure across the board.
Yeah, that's right. Let's go through the first one. Affordability. This one's pretty easy one to explain. Apartments are cheaper than houses, significantly cheaper, and there's more of a push to affordability in a high interest rate environment. And more people are starting to look at their borrowing capacities and being pushed into a lower budget profile. And as a result, they're shifting their preferences from houses, townhouses, and things like that to apartments because they're getting better value for it. So what do you think of that?
Yeah, I think that's a fairly just logical statement, really. Like with prices are where they are at the moment, particularly in Sydney, for house prices, for a lot of people, and borrowing powers, for a lot of people, you're seeing apartments being the choice, not necessarily might be by preference, but just by the numbers. When people run the numbers as being like, look, if I want a house, that's $2 million, $3 million or something, that's not affordable for me in my current life circumstance. I still want to live close to where I work, or, I have other priorities to meet when I'm choosing, accommodation. So apartments kind of, fit that metric, basically. You trade off some things, but it ticks a lot of boxes while giving you some more affordable options than if you're only looking at, townhouses and houses.
Yeah, exactly. Look, I'm thinking on the fly a little bit here, but if I look at this current macro setting where interest rates are up, risk levels is just a little bit higher when interest rates are high, and we've got some economic uncertainty around how the Australian economy performs and the global economy performs in response to high interest rate settings, and we're living through that period now. So when I view it like this and I break the sort of asset market, so housing markets all across the world really, into a few different segments, the top segment, the the $5 million plus sort of houses, I really think that's largely unaffected, not really impacted so much by interest rates and things like that. These people are buying with cash, so that doesn't matter. With high interest rate settings, I think the bottom end of the market actually is showing the most resilience, and it makes sense because all the middle groups are where the accumulation of debt is. You need to earn a decent income to get a fair bit of debt, and they are the ones most prone to interest rate increases and feeling the cash flow stress associated with it. Now, the owners of the bottom end, people need a house to live in. They will always need a house to live in. So they're protected a little bit because the middle and upper groups may have to go down a rung, I guess, in this sort of analogy that I'm using here. So the bottom end is protected. And apartments make up more as a percentage of a share on the bottom end versus the top end. Is that fair to say?
Yeah, I think it's just kind of logically stepping it out. If borrowing powers are crunched and affordability is crunched, people are going to lean more towards lower priced options, basically. And the capitals, if you're doing that, that might mean if you were previously weighing up, do I look for a townhouse or do I look for an apartment? More and more people, like you say, in the current circumstances are going, look, apartment, I'm confident that I can cover the purchase price, get the loan for that, and afford the repayments on it. So like you see, there's a bit of a trajectory of people who are in that group where it's maybe 50-50 whether I go for an apartment or I go for a different housing type. Those percentages are changing, and that means there's effectively a bit more demand for those apartments than there might have been in different, say, economic and financial circumstances.
So I'm going to just put this point as resilience. This sector may have a little bit more resilience. This type of product, an apartment, may have a little bit more resilience in the period ahead because they're cheaper.
More affordable.
And they're more affordable. This ties into our second point, which is about relative value compared to a house. So I looked at this amazing bit of research that CoreLogic produced that has the spread cost between apartments and houses. And typically the median house price is about 15 to 20% higher than the median apartment price, which makes sense. There will always be a premium on houses compared to an apartment. But that historical 20% figure that's there has shot up post-COVID to 45%. Now that is, on a chart, it looks ridiculous. It's like, whoa, what happened here? It's just a straight line doubling in that spread, more than doubling in that spread. That is a very unusual circumstance that's happened. So that could be post-COVID impacts where people needed houses, spaces and things like that. Do you think that's sustainable? And will it continue to run? Will we see house prices, double, triple the price of apartments if it continues at this length over the next 15 years? Then, it'll end up there. Or will that normalize back to its historical sort of level?
Yeah, I think that's a really interesting question. I think in the short term, or short to medium term, I would expect that to normalize a little bit more. I think the big gap or the big divergence that we saw was a little bit of a post-COVID effect. We saw this all the time, like during COVID and coming out of COVID, a lot of people were inquiring, saying, I want to buy a house, I want land, I'm working remotely now, I move further away from the city. All those options come on the table. So I would expect that does normalize a little bit. I think maybe the long run fundamentals, land should probably outstrip, the growth of apartments. But I think there's a bit of a catch up basically for apartments that they need to have in order to shorten that gap back a little closer to that 20% mark. That's kind of the long run average.
Yep, exactly. This ties back into another strange sort of point as well, is the value of buildings has inflated a lot during this 3-year inflation period. The cost of building a new home is up 40, 50, 60% over the last few years. And apartments obviously make up a larger build percentage. So the replacement of an apartment building has shot up in cost. So that's part of the reason why apartments could have more relative value compared to houses, because the value of a house is often in the land, not in the building, but the building has appreciated in a sort of anomaly sort of way over the last few years. So apartments may see a bit of a catch up here because of that building being worth more. And it typically depreciates, which is, bucking a trend.
Yeah, and I think that actually leads into the third reason, which is like supply versus demand. So
Yes.
if we're in a bit of a situation where build costs have gone up, but apartment values haven't really gone up sufficiently to compensate,
Yes.
if you play that out, it's going to mean when developers are doing their feasibilities, it's like, well, why am I building apartments then? It's like either not profitable for me or way less profitable than it was before, so it's not as attractive.
Yep.
And in that circumstance, you get a drop in supply or a lack of new supply coming online, which is kind of what we're seeing. And that is what should put the upward pressure on prices to kind of restore that balance again.
For sure.
So I think that's the little window. And to me, that's probably the most powerful driver of what has the potential to push prices up in apartments over the next like 2, 3, 4 years.
Yep.
Is just that there's essentially a total lack of supply. And at the moment, with the prices where they are, developers aren't really incentivized to bring on a whole bunch of supply because their build costs have shot up and their profitabilities are down. So if you have that situation play out, and these things take time too, right? So if you have that situation play out over another couple of years, there's just going to be a shortfall of dwellings, upward pressure on prices. That's kind of how I would summarize it. And that's to me, that's the bigger factor than the other two that came before it.
Yeah, this is a huge reason. You've hit the nail on the head here. The supply of apartments is coming crashing down, and it is not enough to meet demand. There's been a great piece in the AFR last week about this, and it showcases that Sydney specifically is going to be delivering less than half. That is less than 10,000 apartments each and every year over the next few years, 2025, 2026, 2027, the forward-looking window that we can pretty accurately predict at this point. We're just building half the number of apartments that we actually need relative to demand.
Yep.
We have no vacancy at the moment. The vacancy rate is very, very low, and apartment prices are now bubbling. There's pressure building, and that pressure is going to get worse, not better in the short run, as more and more people come in and we don't have enough homes to meet that demand, not even close to enough.
Yeah.
The undersupply effectively is building, and it's going to grow into a very large troubled position. This is the data for Sydney, and it's the same for Melbourne and Brisbane to varying degrees. The data for apartments showcases demand here, supply down here over the next few years, which suggests in the short run, over this 3-year period, apartments will do very well and increase in value to catch up a little bit. That spread is there, the affordability is there, and now there's a huge undersupply. You're hitting a lot of the key metrics for, price growth in apartments.
And the time lag is so long for these things, which is I think where we're seeing, maybe over the next, like you say, 2-3 years, there's going to be that catch up. The conversation around trying to get dwelling numbers up, maybe that's hit the media or it's become a hot topic in, say, the last 12 months maybe. And they're talking about solutions for that now, and some of these solutions are implemented, some of them aren't implemented. But even once, say, the rezonings happen, you've got to get approvals in. Developers have to buy land. You have to get it approved. You have to start construction. You have to finish it. So from talking about solving this problem to actually getting dwellings on the market, available for rent, available for sale, is 5 years. And I would say we're barely out of the talking about it part of
we're still in that.
We're still in the talking about it part of the problem solving spectrum. So that's where this shortfall is going to get worse before it gets better. And that is not something that gets resolved in 6 months or something, or 12 months. It's a 5-year, maybe even longer time horizon. So that's, I think, where we're saying, look, there's this gaping supply demand gap that isn't going to resolve itself quickly. And that's going to put a lot of the upward pressure, on particularly apartments in the next few years.
Yeah. You've convinced me. Apartments are where to place the money at for the short run, at least. This is what I'd say the type of product to buy, not the where to buy so much specifically, but what to buy. Apartments are going to do really well in the short run. I genuinely believe that, looking at the data, going through it in a little bit of detail. It's actually, there's a little bit of an anomaly here. Putting all these together, that affordability framework that we talked about, adding resilience to the market, putting a floor at the bottom end of it, not allowing prices to fall. There's your tick point 1, nice safe investment. The second bit to it is the relative affordability, being like, oh, this looks a bit strange, this chart between houses and apartments. Can house prices continue to grow so much over the next few years with borrowing powers contained, already at peak prices, so unaffordable? It seems like we've stretched that elastic as far as we can go. But apartments, there's a lot of room there. So there's no affordability constraints so much there. And more demand is being pushed in through the population frameworks that we have touched on other podcasts. And the big one is a supply level analysis, looking at approvals, how low they are, looking at dwelling construction starts, and the fact that it's 2024 now. We're in a period where feasibilities kind of are horrible, like you've just said, as of today. And we've been in that position for a little bit of time now. So all of the stock that has come on the market is now absorbed with this really low vacancy rate. So we're in a starting position where it's quite bad, and we're not building anything in the next year or two or three. And then you have all the ingredients for short-term price growth in the apartment sector. So
I think
breaking the adage.
Yeah, I think first home buyers are actually one of the cohorts that I think actually benefit the most out of this, because even when I bought my first apartment in Canberra, and the conversations we have with people, there's often a little bit of a compromise as a first home buyer that you have to make between what you can afford to purchase at the time, the government incentives that you get for new builds and all those types of things, versus maybe the asset that you believe has got the best long-term growth. And for a lot of people, it means you start out with an apartment as the first purchase. That's what I did. That's what a lot of people do. And you're kind of going, all right, I'm picking up some other incentives along the way to maybe compensate me for the fact that it's probably not going to do as well as, a townhouse or a house if I could just approach this with a straight kind of investment mindset. But the tables might have turned a little bit, where in this next little window, first home buyers that are picking up apartments might actually see some really, really good capital growth potential in the first, 2, 3, 4, 5 years of owning it, which could time with, when they're ready to move on to other things. So
exactly.
Just talking it out with you, that's something that I've thought, often for first home buyers, that's a real compromise you have to think about.
Definitely.
But the stars might be aligning a little bit on that one.
Yeah. Housing markets move in cycles, and housing product types also move in cycles. Houses have done really, really well. That's true to form. Houses make better long-term investments typically. That is what the data says. But that doesn't mean you should only invest in houses. In the short run, there is an opportunity in apartments, and the numbers suggest that opportunity is quite large. It's attractive, and apartments will outperform houses over the next few years. That's a little tip from us, something that we believe in, particularly in Sydney, where we've done a little bit of the data analysis there. So that's super useful for our audience to, broaden their thinking a little bit when it comes to thinking about apartments. Obviously, there's specifics to go through there. You want to buy certain types of apartment blocks. You want to make sure strata reports are okay. You want to make sure your building reports are okay. You don't want any mascot tower situations. You don't want any of that sort of stuff, cladding issues. But specific apartments, most apartments don't fall into that category.
Yeah, exactly.
So, ideally, you're not buying into mega high-rise sort of areas, but there's types of apartments to look at. So apartments, good investments in the short run, but we're going to touch on in our very next podcast episode, we're going to talk about planning changes here in Sydney and how they're going to add a lot of apartment supply in the future. So while they make a great short run investment, do they hold up and stack up beyond a 5-year horizon window? That's what we're going to talk about next. Kurt, pleasure.